Good afternoon, everyone. I, Chandan, on behalf of NEN and Wadhwani Foundation, would like to invite you all for this webinar and also introduce our expert. Ms. Radhika Meenakshi Shankar is the founder of Wadhwani Consulting. She has trained more than 1,000 entrepreneurs and mentored many practicing startups. She is the president of Southeast Hyderabad chapter of Bharat Yuva Shakti Trust BYST, and she is engaged in mentoring and guiding many young entrepreneurs. She has nearly 2 decades of experience in teaching entrepreneurship, finance, and commerce. She is a certified mentor under the Goldman Sachs 10,000 Women program held in partnership with London School of Business and NEM. Before I hand over the floor to Radhika, here are a few reminders for the audience. You will all be on mute. You may ask questions by typing in the panel provided. Over to you, Radhika.
Hello, good afternoon. This is Radhika here. I'm very happy to be doing this for you guys. Have you guys heard of the saying, cash is king. Without it, there is no kingdom at all. And I'm very sure cash plays a very, very important role in your business lives, also in your personal lives. But when you look at your business life, you would probably pondering on questions like, have you ever been plagued by questions like, how much money should I keep? Am I keeping too much cash? Or should I keep a little lesser cash? How much cash I should have, first of all? How much cash should I need to start and run my business without any hiccups? How do I rotate the cash in the system? How can I keep cash within my hands grasp and yet earn money? Not keeping cash idle. There are so many questions that can plague one's mind. You would be also probably thinking, am I maximizing my cash flows? Am I bringing the payments quickly and holding to cash as long as I can? Which means, are you paying your suppliers well time that is given to us? How much of extra cash should I keep in bank, in my hand? How much should I keep with my customers? Where should I invest this excess cash? Am I taking the best of discounts? And first of all, am I cash rich? Am I cash sufficient, sustainable, bankable? That's what. Will the bankers select me and say that I'm good? Can I secure funds when I need me? And solely, and that is the way you manage your cash. So cash flow management is very, very important. When we look at cash flow management, the flow of cash happens in your system, and the inflows and outflows happening and how they impact the overall enterprise itself is what is cash flow management all about. So whenever the outflows of cash exceed the inflows of cash, there's bound to be a gap. And when this gap happens and it widens, there is what is called as the liquidity crunch or cash crunch, which can actually kill a very high growth profit-making enterprise, totally. And therefore, when your inflows are more than your outflows, definitely you have a lot of cash surplus on your hand. Now, that's a wonderful scene even for anybody, right? So what we need to see today and for the next few minutes is how are we going to use some tools on how to manage our cash flows efficiently. Let us first look at what is the cash flow cycle and how it happens, right? But for that, when you look at the cash flow cycle, if you can see the screen, you'll find that it starts with cash. For example, it could be your cash in hand plus your various payments that you receive, your sales revenue and all that. And then you need to manage your cash in such a way that you prioritize what are the expenses to be met, what have to be paid first, what all you need through various tools like budgeting. then you make your payments, and then you have to finance all the old purchases that you've made. In other, you pay your, immediate cash payments, pay your credit purchases. And of course, when you do that, you'll obviously again incur more purchases, and therefore you need to look at what are your stocks and how much cash is spent on carrying your stock, right? There is a two costs associated with the inventory in case you are in manufacturing. What are the carrying costs and what are the ordering costs? So based on all this will also be a part of your cash flow. Now, the whole thing has to be managed because it's a cycle, because you receive cash, then you manage cash, you purchase, you make payments for your purchase, and then you again receive cash, you sell the goods, and so on and so forth. So when you look at your cash flow cycle, you can calculate the number of days it takes for your cash to become cash again. Now that is called as the cash operating cycle days, right? So cash operating days or cash operating cycle days or cash flow days is number one, the number of days it takes for you to buy the inventory, right, and make the payment. Now, the number of days that your supplier gives you is actually a minus figure. So suppose if your creditor or your supplier gives you 30 days credit, then that's a minus 30 days, right? And the number of days it takes from the day you actually place the order for the inventory, you receive the inventory, to the number of days that it takes for you to pay that money, that's a minus sign, 30. From the day you actually pay your money to the supplier to the day you actually make the goods and sell it to your customer is one cycle. Let us say it's about 50 days. And from the day you actually sell the thing to the time you actually receive the payment from your customer is your collection period. Let's say it's about 50, another 60 days. So 60 plus 50, 110. And if you look at the number of days, this 30, that minus 30 that you have is actually, if you add the entire thing, is 140 days is your gross, but your net is only 60 plus 50, 110 days, your money is flowing in the system. 150 days, there is also some part of another person's money that's flowing in your system. So you need to look at how many days, that is the net cycle, which plays a very important. So you need to assess what is your net operating cash cycle days. Now this is the first tool that you need to keep. How many days is your money playing in the market? Now when you look at it, there are two types of cash flows in your system, one towards your capital expenditure and the other towards the operating expenditure. Now, when you are a startup, the initial capex or the capital expenditures are very, very high, and therefore it requires a lot of cash. Most of the time, the capital expenditure are purchased on installments, so we need to keep track of what are the installment money that needs to be paid towards these capital expenditure. The operating expenses, on the other hand, talks to you about your working expenditure and the amount of cash that you require to actually do the day-to-day operations of your business. And we need to know how much is your monthly expenses for operating, or your quarterly expenses and so on and so forth. How much cash need to be needs. This metric is something that you guys have to prepare and keep. You also need to keep in mind that these cash flows are time bound. So you could have short-term expenses and long-term expenses, seasonal expenses. So there are many of these. So keeping your time in mind while you calculate your cash operating cycle, you also need to be very much prepared how much money you require and how much are you going to use from your savings, how much have you to source. So there are different sources that are there for short-term needs and different sources for long-term needs. You need to identify these and then therefore find out what is the best source that you can get and access. Develop this and keep it ready. usually most of the time when we are sinking and we are actually running out of cash, and you say, hey, let's borrow and then run around, then you get a very, very bad deal because you cannot negotiate. So one of the best ways of managing cash is to identify these sources beforehand and keep them handy so that we can dip into them whenever we need. It's also a good prudence to have some savings for a rainy day. Another important problem that challenge that entrepreneurs face while doing cash flow management is evaluating what are my needs, when do I need them. So evaluation of which is the priority cash payments that have to be made. Who should I pay first? When should I pay? How much should I pay? Is it the right amount to pay? Am I raising the money at the right amount of interest? So evaluating how much either your sources or your payments is very, very important. For that too, you need to have some metric. Also, predicting or forecasting, very, very important. Very important because unless you prepare a budget, unless you plan how much cash you require, how will you get this cash, it's going to be difficult. But then you are doing the plan for a futuristic era. So therefore, when for a period that is very much in the future, and therefore predicting and forecasting what could be your sales and therefore what could be your expenses and therefore what are the possibilities from where you can get cash is a prior plan. Not always everything goes according to plan. So having contingency plans also helps. Also having backups for what may go wrong really, really helps. So predictability is one big challenge. How much I need in the next 6 months is a very important challenge, and it's got a myriad of variables which needs to be considered before you predict how much cash you got. Okay, we have planned, we can predict, and we have planned, but how do we keep control? This is very, very one of the most challenging because things may, as Murphy law goes, things don't happen the way you want them to go, and therefore keeping a control, a tight control over your expenses, seeing that they don't cross your danger marks, which means you need to mark your danger levels of cash flows. And this is another important metric that entrepreneurs need to keep in mind. Now, there are many tools for you to manage your cash flow. The first one is the cash flow statement. Then there is the cash budget. Then there is the bank and cash reconciliation statement. And of course, there is the petty cash statement systems that you can involve. Besides this, there are other tools like building cost efficiencies that can release cash for you by having a very tight control on your cash operating period. Let us look at some of these tools. One of the most important thing is the cash flow statement. Profit is an opinion, but cash is a fact. That's what Mr. Narayan Murthy of Infosys has said, because profit is a book profit, and it is based on the accounts and the rules and the laws of the land. And therefore, within the laws, we can always write and our accounts keeping the law as a boundary, and within the law we can actually make use of a lot of the you know the law has given us a lot of subsidies and all those things, and we can look at whether this profit is actually. But when you look at your cash profit, where you look at, for example, the law allows you to have depreciation, which is a non-cash item. So your profit can be shown at lesser figure, and therefore your tax will be lesser because depreciation is allowed by law. But when you look at your cash profit, which is purely cash, which takes into account only your cash revenues and your cash payments, then the profit or loss that you get is actual the reality, and we will know exactly. So that is why that is a fact, while a profit is an opinion because it depends on what type of you use, what type of professionals to use this to actually write and prepare your financial accounts. Now, fast-growing companies face a lot of liquidity crunch due to the mismatch of inflows and outflows. More often than not, the culprit for a high-growth startup is basically only the mismatch of the inflows and outflows. I know many of you guys who are startup, you would have struggled hard, and suddenly there's a boom in your business, and then there's a lot of sales happening, and then you'll find that there's no cash to finance it. Now, this typical. I know it sounds silly and it's oxymoron, but if you're having a cash crunch, believe me, you're on a great growth path, because you guys are having a lot of orders to meet, but you're not having cash to meet that orders. Now this means it is an internal problem, which means you guys have grown too fast, but your systems are not compliant with cash flows that are compact enough to fund those contracts that you're getting. So understanding that financial profits and cash levels are not identical, the first thing that I told you, is very, very important when it comes to talking about liquidity crunch. So you need to look at the most important tool, and that is your cash flow statement. Now, cash flow statement is also mandatory by law. While you prepare your business plans for your pitching to your fund, for any funding or investors, it's very important that you predict your cash flow statement for 1 year at least minimum, and your financial statements predicted for the next 3 to 5 years. Now, since that is mandatory there, it's also mandatory for you to understand what is a cash flow statement so that it can be of use to you personally. Understand, this is the cash operating cash cycle that I talked to you about. So you will find the inventory received, which is on your extreme left corner. The inventory received till the payment of inventory, this is that minus 30 that I was talking to you about. That is the number of days that the supplier gives us to rotate his money. So this is actually, for us, it's good. Whereas we are holding the inventory from the day we receive the inventory till that it becomes a finished goods. Now this number of days in which we are holding the inventory involves cash carrying costs, etc., etc. So all these number of days is the amount of money that we keep on tied up in terms of our inventory. The day we sell it, then the goods are sold, that is the middle line, and from then on till the time the customer pays us money is our collection period. So if you see the top, days holding inventory plus days of accounts receivable together is your gross cash operating cycle. Whereas from this, if you minus this 30 days, what you get, this 110, is your net operating cash cycle, where only your cash is playing. So this is what you need to understand. Coming back to the cash flow statement, the cash flow statement is by law divided in very conveniently into three parts. The first part is your cash flow statements or that relates to your financing activities. Now, what are the possible cash inflows and outflows that can happen during a particular period under financing activities? Financing means raising money or returning the money. So when you raise money, either by way of getting a new partner, or by raising more equities, or by getting a new loan, or by getting in some funder to invest in your company, all these are cash inflows from funding activities. On the other hand, when you repay back a loan or when you draw money from your account, then such expenses become an outflow in the funding scene. Now, when you look at investing activities, we are talking about cash inflows and cash outflows for a particular period that pertains to assets. So, if you are purchasing any new long-term assets, or if you're selling off your long-term assets. So when you purchase, it is an outflow. When you sell, it's an inflow of your cash. So this comes under investing activities. But when we are talking about operating activities, we are talking about the day-to-day expenses and the day-to-day incomes that happen due to the course of operations of your business. So your cash inflows under this is your sales main inflows, and outflows are all your expenses. Under this, you will have, this is where the operating activities is the place that you have to be very careful about, because you need to be very careful what are the cash inflows in operations and what are the cash outflows in operation. Now, this particular statement will clearly show, when you prepare it for a futuristic period, it will clearly show what could be possibly the cash requirements that are required for all these activities. Now, on the other hand, when we prepare another statement, and that is your cash budget. The cash budget is actually a calendar which is based over the months or even weekly, prepared in conjunction with the opening balance of cash. And what we need to do is here, we take the opening balance. Let's say we are preparing a monthly cash budget. Then the opening balance of cash, which is there on January 1st, then to that you will add what are the possible cash inflows that are going to happen in the month of January, and what are the possible outflows that are going to happen in the month of February. Outflows will give us the closing balance of January. The closing balance of January then becomes the opening balance of February. Now, in the month of February, the possible inflows and the possible outflows will then help to give us the closing balance of February, which will then give us the opening balance of March. So, based on this, a 12-month, maybe a calendar-oriented cash budget plays a very, very important role. You can do this even in your Excel. So, it becomes very easy just predicting like, okay, perhaps in the month of August, you need to pay that insurance, or in the month of September, you need to pay the installment, so on and so forth. Why you predict it beforehand, this will help us to understand how much money gap is there, how much is the inflows and how much is the outflows, and therefore what is the balance. Is there a deficit? Is there a surplus to carry forward next? Even if in February, in the month of March, there's a deficit, that means in the month of April, are we getting more inflows, or should we borrow more money? So that way we will know exactly, at least not exactly, at least we'll have an idea when is going to be the cash crunch or the cash surplus, and we will know sort of the tide that is going to flow within our business. Now, the next thing that I want to talk to you about is one of the biggest problems that most entrepreneurs face will be in terms of building cost efficiencies. And in this, when you're looking at your collection period, this is where you sell your goods on credit. And remember, your system works with a predetermined number of days of credit. So, for example, if your gross cash operating cycle is about 150 and your net operating cash cycle is 110, which means your system is prepared for 110 days to rotate your money. On the other hand, if you have already given your debtors 40 days credit, but in reality, you find that your debtors are paying, some pay within time, some pay a little late, some pay grossly overlate, some don't pay at all, right? Now, when you need to know this, one of the things that you can do is you need to just take what is your average sales per day and take out your outstanding and divide your total outstanding from your customers by the sales per day. Now, this will give you the speed of your collection. Preferably, don't take, take only the credit sales, don't take your cash sales. And similarly, take only the amount outstanding. Now, once you get this, suppose if you find that this answer is coming to 61 days, right? And your system is prepared for 40 days of thing, and it's already 61 days, which means your system is already strained by 21 days, which means 21 days you are financing another person also along with you. So therefore, this is one tool. Another tool is your stock. Similarly, if your stock is you are having a stock that is piled up in your go down, one of the things that you need to see is what is your average cost of goods sold per day. You take your annual costs and divide it by the number of working days, you get your cost per day. Now, based on this, you divide this. This will tell you that the number of days your stock is lying in your godown. Now, for example, you are mentally prepared for the stock to be there for 50 days, but you find that the answer you're getting here is 30 days, then it's really good. Your stock is moving really fast compared to what your system is prepared. So so you must be having surplus. But if the answer is like 80 days, that means 80 minus 50, 30 days, you're again straining. Already debtor strain of 20 days plus stock strain of 30 days. 50 days, there is already a lot of strain on your cash flow period system. And suppose if your creditor has given you 40 days, but you're paying him within time, within 20 days or 25 days, 15 days is again the, you're paying him. Now that is indicated by your total amount, that is credit that has come, again divided by cash cost per day. We give you the creditor's velocity. Now if your creditor velocity is 40 and your answer comes like 25, that means you're paying very fast. If your answer comes like 50, you're actually good, right? So knowing these velocity days really helps you to keep track of your cash flow operating cycles and see whether you're straining or how many much are you being very generous and funding other people's speed and activity. So this is very important for you to understand the velocity rates of your business. We already saw what a cash budget is. So you can make them for a year, you can make it for a month, you can make it for weeks, and therefore you can also predict what will be the balance on your cash. Buy inventory as fast as cycle. That means annually for 3 cycles how much you need to have. So always try and have at least one cycle, 1.5 cycles to 2 cycles of cash ready with you. And be prepared for the third cycle with the source. So that is the things that you can do to manage your cash system. Yes, Chandan, next question.
Next question is from Syed Ahmad. Is asking, I understand that the government has waived off taxes for startups. Can you explain about it?
So from time immemorial, the government has been giving a lot of subsidies and tax holidays for small and micro enterprise, micro, small and medium enterprises. This is not something new. But now the government has come up with a little more. They've added to this by saying all startups will be given a tax holiday. So usually you start paying your taxes when you start making some profits. And in a startup, this becomes very difficult because initially these profits that you make are plowed back into your business to run your business, because that's when you bootstrap, you don't borrow. So therefore, the government has given this thought and have said that all startups will be getting a tax holiday in terms of non-payment of sales tax or income tax and so on and so forth. So that is, I think, for 3 years, if I'm not mistaken. I'll have to get back to you based on the law.
Okay.
Thank you. Next question.
Next question is from Sumit. Sumit Sarkar. He's asking, it would be great if you can talk about cash operating cycle methodologies once again. I think he missed that particular part.
Okay. So the cash operating cycle is defined as the number of days your cash floats in your system. To calculate this, you need to calculate A, the number of days of credit that your supplier gives you to, when he supplies goods to you. So that is A. B is the number of days it takes for you to receive the inventory and convert the inventory into sales. So the number of days that it takes for your raw materials to become stock and stay as stock till it converts itself into a sale. Now that is your stock holding period. That is B. C, the number of days that you sell the goods to your customer, and the number of days you have given your customer time for paying. That is your credit period that you give your customer. That is C. Now A plus B plus C will actually give you your gross operating cash cycle. On the other hand, B plus C gives you only your net operating cash cycle. Or you can say gross operating cycle minus A, which is the number of days your creditor is giving you or your vendor is giving you, gives you your net operating cash cycle. The net operating cash cycle is very, very important because it tells you the number of days your cash alone is playing in the system. Now, when you use the tools of velocity, you will get the actual number of days your system is actually bearing. The number of days, your collection period, your average collection period. Your system is prepared for 40 days. You are mentally prepared and your cash operating cycle is 110. 40 collection and 50 is your stock holding period. So 50 plus, sorry, yeah, 50 plus 60, 110. We are looking at, suppose if you have given 60 days of credit to your customer, but your customer pays in 80 days, right? Then 20 days is the excess of number of days where your system is strained. Similarly, if your stock holding days is 50, but if you find your actual speed of your stock turnover is actually something like 90, then 30 days more your system is strained. So 90 minus 60. So when you look at the strain overall, ultimately 110 days, but it is being strained to something like 60 days, your money is, where are you? You're cutting yourself to give money into the system. Then that is the bleed and that causes you the cash crunch. So understanding your cash operating cycle number of days helps you what your system is prepared for. And in reality, when you do the check, how many days on an average you're collecting money on how many days actually your stock is sitting in your godown. These things will help you to understand your cash operating cycle much better and understand how much is straining your system. Thank you, Chandan. Next question.
Next question is from Anup. This is a very normal question. I mean, very challenging question. All the entrepreneurs they face. He says, in India, traditionally customers are not very good at paying on time, often delaying by about 3 to 4 months per bill. So, in this situations, what should be the approach so that it can motivate customers to pay on time?
This is a question that is worldwide, troubling all entrepreneurs, not only Indians. Okay, so it is prevalent everywhere in every country. You know, there are umpteen amount of research that has been done to help people and understand, you know, should I give credit? So they devised credit rating agencies and all that. So you were asking, what are the tips for you that would help you to understand and collect your money faster? Well, across the number of workshops that we've done with entrepreneurs, with NEN and the Wadhwani Foundation, we have come across entrepreneurs who come up with their own myriad ways how to test. You know, I still remember somebody telling me the first thing I ask is the watchman and ask him, does he pay you salary well? And if he pays his watchman well, that means he's, you know, going to be prompt in my payment too. I mean, this is just on the flip side as a joke, but honestly, there are a few things that you can actually do to keep your collections well within the reach of your time limit. The first is, of course, giving timely reminders, and it's impossible that you don't antagonize your customer, so it should be very subtle. It's like, I'm passing by this way, I just thought about the money, just 1 week before the due payment, just go and make yourself visible. That is one. Two, you could possibly you know, send it for collections, or there is a new thing that is called factoring these days, where you can actually you know, give off your amounts outstanding and sell it off and pay a small fee for it and get at, or you have to pay some discount, at least you get the money back. So the chasing is done by factoring. So you could always go and tell your customer, if the customer says, hey, what did you do? I'm having this guy breathing down my neck. You can say, I'm so sorry, sir. I really don't know what's happened. I've already sold this because I was in a cash crunch. So I'm very sorry. Please let me know what to do. So that way the blame is cleared out of your head. Another, probably you could also come and say that, you can give it for collection, and then, you can tell the customer, oh my God, I'm very sorry he's troubling you, but I think I need to get back to him and tell him that you're a very important customer and not to harass him types. So these sort of drama bazi that you can do, but basically outsourcing your collections, though it is costly or it may bring down your cash. But another important thing is basically to develop good relationships. And that can be done by keeping yourself visible, by talking to these people, by understanding and impressing upon them, and being very subtly telling them. Now, if your customer tells you, I'll pay in a week's time, then please make sure that you don't trouble him for the next 1 week. Because if you have given him 1 week's time, please don't trouble that 1 week. But after that, maybe you should. So these are things. But most important is, do a lot of credit checks before you even lend your goods. In the zeal for making a sale, we sometimes just sell it to anybody and everybody. If we are being very careful about doing a little bit of a credit check on the customer even before you actually sell to him on credit, it will go a long way in your cash management. Thank you. And Chandan.
Yes, we have next question coming from James. He's asking, you have mentioned various tools available in the market. What sort of tools? Also, if we can have a simple system to follow.
Uh, James, there are a lot of free websites. Then there is the SME toolkits that are available, and there is a lot of formats which are ready-made available. You can yourself, if you are very good at Excel, you can work all these out on the Excel too. But you can get a lot of these things like the SME toolkit of the ICICI Bank and IBM. There are many things like that. There is freebooks.com. So there are many places where you get these formats. You could use them if you are very computer savvy, and actually work out on these formats to help you. Uh, and you can actually Google sometimes. You just Google, you would get all these formats. Talk to your auditor, he'll be able to help you with this a little more. Or any BCom person would be able to help you with this.
Okay.
Thank you, Chandan.
Yeah, our next question is from Mr. Srinivas. He's asking how to teach cash flow requirements for engineering students for engineering startups.
Oh, this, Mr. Srinivas, is a very, very difficult question, because most of the time the technical entrepreneurs are so techie savvy, and they have this myopic thing of making a fantastic techie product. And the costs associated, or the financial association with this in technical entrepreneurs, is actually given a very least priority. The most priority is given for the technical enhancement of the product. I have so many of these techie entrepreneurs who come to me, and then they are more interested in making the product much more better. And when you look at the finances, it's given a very low priority. So yes, it's very difficult, but this as a mentor needs to be emphasized, that there is a cost. For example, most of the engineering students, you have the cost associated with the project. So understanding that when you build a single product, the cost is more, and when you actually do and go on a larger scale, when you're producing it in a larger scale and you're buying bulk, then the cost comes down. Something, that's point that you need to put it on in the heads of the entrepreneurs, young entrepreneurs. The most important thing is understanding that there is a cost for the materials. Is very easy because we have the bill, but there is a cost, that is the labor cost. Since we are using our brains and we are trying to drop, let's say, the software, or trying to put in the circuit or whatever, the time that as engineers we spend, our knowledge, that cost has to be factored. More or less, it's my product, I'm building it, my project, we don't factor the knowledge cost. So the cost of the mentor, the cost of the engineer who's actually working and building the prototype needs to be taken For this, you can take like what would be the probable cost of hiring a professional like you, how much would we need to pay, and if it's a monthly salary of so much, let's say 60,000, then we will look at 45 days of services rendered or how many hours and calculate based on that. Some we can take some basis, a justifiable basis has to be taken, and the labor cost. This is one part which these guys will never, put in a factor in. So besides the material cost, you have the labor cost. Plus, there is also an overhead cost. For example, the use of lab, the laboratory, electricity, or the internet. These things have also to be factored in. With all these things, even for a single product, we need to look at the cost that is. Now, sometimes what happens is you've already spent a lot of time and you've built a platform, and from then on you're only using the platform, right? So when you build a platform, you need to find out the entire cost of building the platform, and then you need to work out on your sales. So yes, I'm making the young engineers understand that building a single product vis-a-vis commercializing and producing a lot of those products, the cost will change. B, it's very mandatory that they need to know and factor in labor costs, overhead costs, along with material cost when they are calculating the cost of their product. 3, you need to also compare it with the commercial products or near substitutes that are available in the market to understand what is the selling price at which you can sell the current product. So I hope these tips are useful, Chandan.
Yes, very much. We'll take a last question. It's from Rachna. She's asking, what is the ideal cash flow cycle for a startup?
Depends on what is the nature of your industry, right? If you're a service, then there is no question of stock number of days. So it's basically the service that you render, the number of days it takes for you to actually render the service. So if you look at manufacturing, then the cycles would be different. So we need to look at the nature of the industry. Then you need to look at what is it, a product or if it is a service, and whether it is a knowledge product or it is a regular service. So these are all the various things at which you need to know what kind of a startup you are. Plays a very important role in deciding your cash operating cycle. Thank you, Chandan.
Thank you very much, Radhika, for that interesting session. Thank you all our attendees for participating in this webinar. We are glad that questions kept coming in, but due to lack of time, we are unable to answer all. And Radhika has shared her contact details, so probably if any doubt, you can reach out to her. She will be happy to respond back to you. Also, if you found the session interesting, feel free to blog or post about it. The recorded version of this particular webinar will be available on our YouTube channel by next week. Join us for our next webinar on design thinking by Mr. Rishabh Jhol on coming Wednesday, February 24th at 3 p.m. Thank you once again and have a nice evening.